Looking at the bigger picture. Now that you've learned key candlestick patterns, it's time to step back and see the market's overall direction. Patterns show short-term moves. Trends reveal whether the market is climbing, falling, or shifting. Mastering trends helps you trade smarter. Let's dive in. You may already know this, but let's make it clear. A trend is the overall direction the market is moving. In an uptrend, prices are generally rising. In a downtrend, prices are generally falling. Recognizing the trend helps you trade with the market, not against it. In an uptrend, each peak is higher than the last, and each pullback doesn't fall below the previous one. This shows buyers are in control, pushing prices higher over time. In an uptrend, traders look for buying opportunities, aiming to enter on pullbacks and ride the trend upward. In an uptrend, swing highs are points where the price reaches a peak before pulling back. They show where buyers are slowing down and sellers are stepping in. If each swing high is higher than the last, the trend is strong. These points help traders spot good times to exit. When the trend is upward, traders use trend-following strategies to profit from the ongoing rise. They often buy during pullbacks. To protect profits, they place stop losses, adjusting them as the price moves higher. The key is to stay with the trend until clear signs of reversal appear. In a downtrend, price forms lower highs and lower lows, showing seller control. Traders look for selling opportunities, often entering after small rallies, aiming to follow the downward momentum. Pay attention to swing lows that happen when the price drops to a low point and then starts moving back up. In a downtrend, swing lows often get lower, showing sellers are in control. Knowing swing lows helps traders identify good entry points or when a trend might reverse. In a downtrend, traders also follow the trend by selling when the price temporarily moves up. To manage risk, they set trailing stop losses above recent highs, locking in profits as the trend continues downward. The goal is to follow the trend until signs of reversal appear. Let's match trends. Look closely at the charts. Are prices rising or falling?
Yes, you're right.
Well done! You correctly identified the trend based on how the highs and lows are progressing. Spotting trends like this is key to understanding market momentum. At first glance, spotting whether the market is bullish or bearish may seem easy, but predicting what happens next? That's where it gets tricky. Market prices don't move randomly. They reflect the decisions of countless traders reacting to emotions, expectations, and news. Behind every price shift is a battle of supply and demand, driven by psychology. By spotting these patterns, you can better anticipate what might happen next. Imagine a stock priced at $100 suddenly falls to $90 due to disappointing earnings news. Traders fear more losses, quickly selling their positions. This selling pressure pushes the price even lower to $85 and then to $80, creating a bearish trend. Now, consider a stock that moves from $50 to $65 after news of a breakthrough product. Traders see a chance for easy profits and rush to buy. This spike in buying drives the price even higher, from $65 to $70, then to $75, forming an uptrend as demand increases. A strong trend is usually supported by good volume. For instance, during an uptrend from $100 to $120, increasing volume confirms buyer confidence. But if the price rises from $120 to $125 on low volume, it suggests weakening momentum and possible reversal ahead. Now, let's look at this stock that has been climbing steadily, rising from $200 to $220, then to $240. Each move is supported by strong trading volume, but now something changes. As the price approaches $245, the volume noticeably drops. The price struggles to push higher. This signals that buying interest might be fading. Without enough buyers to sustain momentum, some traders may start locking in profits. If selling pressure increases, the uptrend could weaken or even reverse. However, no trend continues endlessly. Even in the strongest trends, prices often pause or shift temporarily. These pauses are known as pullbacks, short-term moves against the trend. For instance, after a stock rises steadily from $20 to $40, some traders close their positions to secure gains. This profit taking temporarily drops the price to $35, creating a pullback before potentially resuming upward momentum. Pullbacks happen in downtrends too. Imagine a stock falling steadily from $80 to $60. Some traders might see this drop as a buying opportunity, briefly pushing the price up to $65. However, if selling pressure remains strong, the price soon resumes its downward move, continuing the downtrend to $55. You're analyzing stock ABC. The price climbed steadily from 150 to 165, then to 172. Recently, it pulled back to 168 and has been struggling to break above 172 for several sessions. What would you do next based on this price behavior?
No, the correct answer was
Wait and watch. Not quite. When a stock struggles to break through a resistance level, it's risky to act too quickly. Waiting for confirmation helps you avoid false signals. Nice work! No matter which action you choose, you've seen how price behavior can hint at what's coming next. A pullback is a small pause before the trend resumes. A reversal, however, flips the entire trend. It happens when the market shifts direction, from an uptrend to a downtrend, or from a downtrend to an uptrend. The patterns you've already learned, like engulfing, doji, hammer, and shooting star, often signal these reversals before they fully unfold. Spot them early, and you'll be ready to adjust before the market moves. Great job! You can now confidently spot uptrends, downtrends, and reversals, all key skills for making smart trading decisions. But remember, trends don't move endlessly. They often pause or reverse at important price levels. Next, we'll explore how to identify those key price levels so you can better predict where the price might bounce, reverse, or break through. Let's keep going. Spotting market support and resistance. Every trend faces key price levels where momentum pauses, reverses, or breaks through. In this section, I will show you how to spot support and resistance, and how to recognize powerful breakouts when they happen. Let's dive in. Support and resistance are critical price levels where the market often pauses or reverses. Think of them as invisible barriers. Support acts like a floor, while resistance acts like a ceiling, shaping price movement. Let's look at resistance first. When the price reaches this level, selling pressure increases, and the price often stops rising or even falls. Many traders use resistance to take profits or look for short sell opportunities. In a strong trend, old resistance can become new support. Once the price breaks above resistance, it may pull back, but that resistance level often becomes a new place where buyers step in. Spotting this helps you enter trades with the trend. Now, let's look at support. When the price drops to this level, buying pressure increases, stopping the price from falling further. Traders use support to find buy opportunities or set stop losses safely. Let's break down how traders apply these levels to make smart entry, exit, and stop-loss decisions. When the price approaches resistance, it often struggles to move higher. Traders can take profits near resistance after a strong uptrend. Open short, sell trades, expecting the price to reverse downward. Place stop losses just above resistance to limit the risk if the price breaks through. Let's test your understanding. In this bearish trend, where would be a good potential entry point based on support and resistance? Where's the most promising entry point based on support and resistance?
yes, you're right.
Exactly. The resistance level is the most promising entry point in a bearish trend. It's where sellers often step in, potentially ending the rally and continuing the downtrend. In contrast, when the price approaches support, buyers often step in. Traders can 1. Enter buy trades near support, expecting the price to bounce upward. 2. Place stop losses just below support to protect against breakdowns. 3. Add to positions if the price holds and moves higher from support. Let's test your understanding. In this bullish trend, where would be a good potential entry point based on support and resistance?
No, the correct answer was
At the support level. Not quite. Consider where the price is likely to find support in a bullish trend during a pullback. The support level is the most promising entry point. It's where buyers are likely to step in, potentially ending the pullback and resuming the uptrend. But price doesn't always bounce off these levels. Sometimes momentum builds and the price breaks straight through support or resistance. These moments are called breakouts, and they often lead to strong, fast price moves. Breakouts happen when price repeatedly tests a support or resistance level, building pressure. Eventually, buyers or sellers take control, pushing prices beyond the level, often triggered faster by major news or events. A bullish breakout happens when the price breaks above a resistance level. This shows strong buying pressure, and traders often buy, expecting the price to keep rising. A bearish breakout occurs when the price breaks below a support level. This signals that sellers are in control, and traders may sell, expecting the price to fall further. When trading breakouts, timing and risk management are key. Traders typically enter a buy trade when the price breaks above resistance, or enter a sell trade when the price breaks below support. To protect themselves, they place a stop loss just outside the breakout level, below the breakout point for bullish trades, or above it for bearish trades in case the breakout fails. How will you respond to the breakout? Take a look at stock ABC, which has been trading between $50 as support and $60 as resistance for several weeks. Suddenly, the price breaks above the $60 resistance level and quickly rises to $63. Based on this price movement, what action would you consider? Would you sell, avoid trading, wait and watch, or buy?
no, the correct answer was
Buy? Not quite. A breakout above a well-tested resistance level is often a bullish signal. Ignoring it or acting too cautiously might mean missing a potential opportunity. No matter which option you choose, the key takeaway is this. Breakouts offer exciting opportunities, but they require careful analysis. Strong momentum often continues, but breakouts might fail, trapping traders. Watch out! Sometimes the price pushes briefly beyond a support or resistance level, but quickly reverses. This is known as a false breakout. It can catch traders off guard if they enter too soon. To avoid this, traders wait for confirmation, such as a strong close beyond the level or a retest where price holds above or below the broken level. They also check for increased trading volume, which signals stronger momentum and makes the breakout more reliable. Quick task. Action plan. You're watching a stock test the $100 resistance multiple times. Finally, it breaks through and jumps to $105. Think like a trader. How would you plan your entry and exit? Reorder the steps to build a strong breakout strategy. You've learned to use support, resistance, and breakouts to trade smarter, but markets don't always trend. Sometimes price moves sideways between key levels. Next, you'll learn how to spot these ranges and adapt your strategy. Market ranges versus trends. You've learned to spot trends, reversals, and breakouts. Now it's time to ask, is the market trending or stuck in a range? In this section, you'll learn how to identify range-bound markets and trade within the range, or catch the breakout when the price breaks free. A range-bound market occurs when prices oscillate between specific highs and lows, creating a horizontal channel. The upper boundary acts as resistance, while the lower boundary serves as support. In this environment, prices lack a clear directional trend and move sideways within a confined range. Imagine a stock fluctuating between $50, support, and $60, resistance over several weeks. Traders observe that each time the price nears $50, it rebounds upward, and when it approaches $60, it retreats downward. In this kind of market, traders take advantage of the predictable movement. They buy near support, $50, expecting the price to bounce up. They sell near resistance, $60, expecting the price to pull back down. This strategy is called range trading. It works best when the market shows no clear trend and keeps bouncing between the same levels. But no range lasts forever. At some point, the price may break out of the range, either above resistance or below support, signaling the start of a new trend. When a breakout happens, buyers step in when the price breaks above resistance, expecting continued upward momentum. Sellers take control when the price breaks below support, expecting the price to fall further. Traders enter trades in the direction of the breakout, often setting stop losses just outside the old range to manage risk. Quick check! The stock has now surged to $61, breaking above the previous $60 resistance with strong momentum and high volume. What should you do after spotting this breakout?
Yes, you're right.
Well done! A breakout above resistance, especially with strong volume, is a signal to buy. Traders expect the price to continue rising. Once the breakout holds, the market often shifts into a clear trend. This is the perfect time to use what you already know, trend-following strategies. Enter in the direction of the breakout. Use trailing stop losses to protect profits as the trend grows. Stay in the trade until you spot clear signs of reversal. What are you going to do? A stock is in a clear downtrend, forming lower highs and lower lows. After a brief rally, the price hits a resistance level and starts falling again. What's the smart move using a trend-following strategy?
No, the correct answer was
Enter a sell trade as the price resumes falling. Not quite. In a downtrend, the strategy is to sell after rallies, not to buy or stay out. Great job! You've built a strong foundation in technical analysis. You now understand how to recognize market trends, spot key levels like support and resistance, apply trend following and range trading strategies, and identify important candlestick patterns. These skills will allow you to read charts confidently and make well-informed trading decisions. But this is just the beginning. The more you practice applying these concepts, the more effective and confident you'll become in real market conditions. Ready to take your skills to the next level? Let's continue.